Welcome to our Hurst Cycles webinar for the 13th of November 2017. My name is David Hickson, and as always, before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Before we take a look at the markets today, I would like to ask your indulgence because I would like to pay tribute to a very important member of the Hurst Cycles community who passed away last month. And I'd like to spend just a couple of minutes telling you about his contribution to our community and to the world of Hurst Cycles. His name was John Eastreich, and many of you probably would have known him by his avatar, which was Silent One. John published to trading forums for many years about Hurst Cycles using the nickname Silent One. And when I started developing the software that eventually became Sentient Trader, I had a small blog, and in those days it was called the Hurst Trader, the software that I was developing. And John was one of the very first people to contact me and to provide encouragement and support for me to develop the software. He was a wonderfully generous man with his knowledge and his experience, and he was the most extraordinary Hurst Cycles analyst. He was the first person that I met who could look at a chart and perform an analysis, without needing to pull out a pencil or sort of make any marks on the paper. He could just look at a chart and almost instantly analyze it in his mind. He provided tremendous support for me and taught me a huge amount about what makes a good Hurst Cycles analysis. And in many ways he was really influential in motivating and teaching many of our community today. Over the years he became a good friend of mine, and I was delighted to do a good deal of work with him. In the old days he used to give me suggestions about what was happening in the gold market. Precious metals were a particular speciality of his, and I made many very profitable trades thanks to John's advice and his explanations of how he thought the cycles were influencing the price of gold. In February of this year, I received a phone call on a Sunday night from John, telling me the sad news that he'd been diagnosed with lymphoma, a particularly nasty form of cancer. And over the months that followed, I spoke to John a lot because we were working on some new training material to help people to really understand Hurst Cycles, and in particular to understand them in the way that John always did. And in September he suffered a relapse, sadly a relapse that he wasn't able to bounce back from, and on the 26th of October he passed away. It was a really sad moment, not only for me personally but for the entire Hurst Cycles community. We have lost a true Hurst Cycles legend. So thank you for letting me just pay a brief tribute to John and his community and his contribution towards our community, which really was huge. Let's move on now and start thinking about what's happening in the markets and what the Hurst Cycles are doing. I've titled today's webinar The Peak Watch because I believe that it is now time for us to start thinking about what's going to happen next in the markets. So let's just catch up and let me explain why I think we need to start thinking about a peak forming in the markets. First of all, here is a chart of the S&P 500, and the analysis that you see at the foot of the chart is a trough-only analysis, and it's an analysis that I have been speaking about in our previous webinar. I introduced this analysis to you, and you can see here, let me get my pen, you can see here at the foot of the chart that we have a 9-year cycle over there, and we have a 6-year cycle over there, and we have a 54-month cycle over there. Those are the troughs of those cycles. And I discussed this analysis in the previous webinar, so I'm not going to dwell on it now. But of course, you should know that the 6-year cycle is not a cycle that Hurst mentioned. It's a new idea. It's one that's been bouncing around for several years, actually. But the application or the inclusion of a 6-year cycle does help to explain some of the things that we've been seeing in the market recently, in particular these sort of double troughs, if you like, that have been forming in the markets, and the inclusion of that 6-year cycle provide a rationale for why the troughs have been behaving in this way. So this is our trough only analysis, and let me just put up some semicircles which provide us with an easier way perhaps of understanding the analysis. And let me zoom in and look at what has been happening since the end of 2015 with these semicircles, because I think that most Hurst cycles analysts, even if they don't agree with the inclusion of a 6-year cycle, most analysts would accept that the trough in February of 2016, this trough over here, was probably a trough of the 54-month cycle, which you can see is the phasing that we have in front of us. Now, if February 2016 was a trough of the 54-month cycle, then of course we would expect the markets to rise, or to be influenced to rise by the 54-month cycle for about half of the cycle. The 54-month cycle is represented by this orange semicircle over here. And so the 54-month cycle has been pushing upwards. About halfway through the cycle, of course, the 54-month cycle will start influencing prices to turn down. So you can see why I'm suggesting at this very sort of overview level that we should be looking for a peak, because indeed the 54-month cycle is going to be approaching a peak at some time, and we need to be looking out for it. Now, each 54-month cycle, I'm sure that you know, breaks down into 3 18-month cycles. And according to this analysis, we have already seen the first 18-month cycle with the formation of the 18-month cycle trough in August of this year, which again I spoke about in previous webinars, so I won't dwell on that there. But it seems very likely that the 18-month cycle formed a trough in August of this year. We then have the second 18-month cycle that we are currently in, and then the third 18-month cycle, of course, which will carry us to the next 54-month cycle trough, which according to this analysis is also a trough of the 6-year cycle, and indeed also a trough of the 9-year cycle. So according to this analysis, that's going to be a fairly big, fairly important trough. Now, when the market is going to form a big important trough, we expect prices to come down into that trough. Okay, so let's just speak for a moment about these 3 18-month cycles. What do we expect from the 3 18-month cycles? Well, if we only focus on the 54-month cycle, let's ignore the longer cycles for now, then what we would expect from the 3 18-month cycles is, first of all, a very bullish 18-month cycle, which we have undoubtedly seen. It doesn't require an advanced degree to notice that is a bullish cycle. It was a very bullish 18-month cycle. That is, of course, what we expect for the first 18-month cycle in a 54-month cycle. The second 18-month cycle is generally expected, and again, we're ignoring the longer cycles here. So the second 18-month cycle is expected to be neutral in shape, and the third 18-month cycle is then expected to be bearish in shape. Okay, those are the 3 18-month cycles that we would expect to play out within the 54-month cycle. Now, I've mentioned that that is what we would expect if we ignore the longer cycles, of course we cannot ignore the longer cycles, so let's just take a moment to think about those longer cycles. First of all, there is the questionable or debatable 6-year cycle. If that 6-year cycle does exist, and there has been some good evidence, as discussed in our previous webinars, that that 6-year cycle is playing out in the markets at the moment, then that 6-year cycle is approaching a peak as we speak. You can see from that semicircle, okay, there is the peak of the semicircle of the 6-year cycle, which gives us a very good visual indication of what that 6-year cycle is doing. So that 6-year cycle looks as if though it should have peaked probably just a month or two ago, and so the 6-year cycle is turning down. So that would certainly encourage us to expect a peak to form in the markets, and if the 6-year cycle exists, then it will be influencing the markets to drop, to fall down into the next trough, which of course we're expecting to happen round about 2020, in about 2 to 3 years, probably closer towards the end of 2020, so about 3 years' time. Now, the next longer cycle is the 9-year cycle, and again, according to this analysis, that 9-year cycle is already turning down, or it has turned down, I should say, and it is influencing prices to fall. So the 9-year cycle is definitely applying a downward pressure at the moment in the markets. Now, some of you might be saying, well, if the 9-year cycle is pushing downwards, why have the markets been going up so much? Well, usually the simplest answer to that question is because of the longer cycles. And we know that there is an 18-year cycle active in the markets. And let me just zoom out. In this particular analysis, we cannot see the 18-year cycle because it isn't included in this analysis. But it's fairly easy to look at this analysis and say, well, this tremendous bullishness over here, this persistent bullishness, has most probably been caused or has been influenced by a bullish 18-year cycle, which would imply that the 18-year cycle is still currently moving up. And so we still have a strong upward pressure from the 18-year cycle. Now, when does the 18-year cycle actually turn around? Well, the 18-year cycle will turn around when the next 9-year cycle trough forms. So we would expect here an M shape. Price will come down to that 9-year cycle, and then it will move up again, and we get our M shape. Okay. So that is the M shape that should result from the 18-year cycle. I suspect I might have said 18-month a moment ago, but I'm talking here about the 18-year cycle, very long cycle. Okay, so let's go back and ask what this tells us we should be expecting out of the current 18-month cycle. Well, as I've mentioned, the first 18-month cycle is expected to be bullish, and it was bullish. The second 18-month cycle, the one that we're in at the moment, is expected to be neutral, except that, of course, we have the influence of longer cycles. And if the 6-year cycle is active, then the 6-year cycle is soon going to start pressing downwards. The 9-year cycle is already pressing downwards. The 18-year cycle is probably still pushing upwards. So we have a bit of a balance of forces. But as I just indicated from that M shape that I drew for the 18-year cycle, the 18-year cycle is not going to peak exactly at the center of the 18-year cycle, but it is going to form two peaks. It's going to form a first peak, which I believe is approaching. And then, of course, the markets are going to move down into the 9-year cycle trough. Then, of course, markets are going to bounce up again. Okay, so what are we expecting now from the current 18-month cycle, this one over here? Well, we're expecting it to be neutral, potentially slightly bearish. Okay, so if we have a neutral 18-month cycle, then of course we need to start thinking about that peak and looking for that peak so that we can adjust our trades suitably. Now, I'd I'd like to point out something before we start discussing this peak in a little more detail. There is a tendency for cycle analysts to be looking ahead, of course, at the next event that's going to happen. And because we spend a lot of time speaking about it, and because I'm doing this webinar about a peak, that there is often a reaction where people say, okay, so David, you're bearish because you're looking for a peak. I'd like to say I'm not bearish yet. Okay, one of the worst things that you can do is say, because we're expecting a peak, I am now bearish. And I keep drawing these things on charts. I've had people email me screenshots from these webinars saying, according to that screenshot, you're projecting prices going to go down to, below 2,000 or something like that. Because I'm expecting a peak does not mean that I am now bearish. One of the most dangerous things that you can do as a Hurst cycles analyst or any cycles analyst is to immediately adjust your mindset because of the fact that you're looking forward. So to be clear, I am bullish. This is a bullish market until it forms a peak. Okay. Once we have evidence that that peak has formed, then of course I probably will become bearish. But let's not jump the gun. I haven't turned into a raging bear just yet. I do think that a peak is probably upon us, and not upon us. I think that we are approaching a peak, and that we need to tread carefully. Okay, so that is the situation considering only the trough analysis. Now, as you know, and I have discussed this in previous webinars, in fact I did an entire webinar dedicated only to the concept of having a dual analysis in Sentient Trader. So for those of you who are new to this concept, let me just remind you or explain to you what a dual analysis is. Now, on this analysis of the S&P 500, I have two analyses, a trough analysis and a peak analysis. I can turn off the peak analysis. This is a fairly traditional Hurst cycles analysis. It consists of an analysis of only the troughs, which are marked at the foot of the chart. It's not an entirely traditional Hurst cycles analysis because it includes a 6-year cycle, as discussed in our previous webinar. But it shows only the position of the troughs. Okay, and traditionally, when you are looking at only the troughs, if you plot your semicircles, you have an idea of when the peaks are going to form, because between any two peaks of the same, any two troughs, I beg your pardon, of the same cycle, you will of course have a peak. And so therefore, I've just circled two 9-year cycle troughs. Therefore, obviously, the 9-year cycle peak is that highest price over there. So that's the 9-year cycle peak. Similarly, we have a 9-year cycle trough over here. The next 9-year cycle trough lies in the future. And so the 9-year cycle peak is the highest price that that is encountered during that 9-year cycle. That's kind of the definition of a peak. Okay, in between two troughs, you have a highest price, which is therefore the peak of that cycle. And for many years, that is of course the approach that I took. You have an analysis, a single analysis on your chart. It is an analysis of the troughs because of Hurst's principle of synchronicity, which tells us that troughs in stock markets are synchronized where possible. And so we have troughs that occur at the same time. They are synchronous. Okay. Then, of course, I had to come along and complicate things because some markets definitely don't have synchronized troughs, but they have synchronized peaks, in particular precious metals such as gold or commodities, coffee, wheat. Take a look at analyses of those instruments and you will see that they exhibit the behavior of an instrument that has synchronized peaks as opposed to synchronized troughs. And so I enabled Sentient Trader to perform a peak analysis. So a peak analysis assumes that the peaks are synchronized. That's a very important little subtlety. It assumes that the peaks are synchronized, which, of course, when it comes to a stock market, we know is not true because it contravenes Hurst's principle of synchronicity. But because the software could perform a peak analysis and a trough analysis, I, many years ago, started playing around with the concept of performing two analyses. And this is the important point. This is not one analysis where I have identified troughs and then also identified the peaks. That's easy enough to do, as I've just pointed out. You know, the highest price between two 9-year cycle troughs is, of course, the 9-year cycle peak, according to the traditional way of thinking. But when you apply two separate analyses, you have something really quite interesting happening, which is that you have two completely different approaches to what has been happening in the market. And so you have a peak analysis up at the top of the chart, and you have a separate trough analysis at the foot of the chart. I received a comment or a question after our previous webinar asking how it's possible that an 18-month cycle peak could have formed when we have a higher price between two 18-month cycle troughs. Well, the reason for that is because I am looking here at a dual analysis. It takes a little bit of a mind shift. It takes a bit of getting used to. But when you start looking at a dual analysis, several very useful things come to light. And I found a dual analysis to be a very powerful approach. So let's take a look at this dual analysis. And the first thing that is worth pointing out is, as discussed in the webinar, I think it was 2 months ago, I believe that the 9-year cycle peak actually occurred back in 2015. Now, we could debate that and discuss it again, but we did that in our previous webinar, so I'm not going to sort of debate it again. But I think it's a highly likely position for that 9-year cycle peak, that the 9-year cycle peak occurred in 2015. Of course, we could then ask, if the 9-year cycle peak occurred in 2015, how is it that we've seen so much bullish price action and prices rising to ever higher peaks since then? Well, the answer to that is, of course, that the longer cycles are still pushing the markets up. In particular, of course, I believe the 18-year cycle is pushing the market up, and we don't have an 18-year cycle on this analysis, so we can't really see it. But that provides us with a rationale for the fact that we have seen so much bullishness in the markets recently. But let's accept for now, because we did discuss it in a previous webinar, let's accept that the 9-year cycle peak formed back in 2015, and let's zoom in and let's ask ourselves what we're expecting now. Let's clear those semicircles, which never really work when you're zoomed in, and let's start interrogating this peak analysis. Now, the first thing that I must point out when you're looking at a dual analysis is that one analysis will be generally really good, and when you're looking at a stock market analysis, generally the trough analysis is the analysis that you take more seriously, because we believe that the troughs are synchronized. So that is bound to be the better analysis. The peak analysis is probably not so good, because, as I mentioned, the software is taking the approach that the peaks are also synchronized, and we know that that breaks one of the fundamental principles of Hurst cycles, and that probably the peaks are not synchronized. So we have an analysis that assumes the peaks are synchronized, but we know that they're not. Okay, some people would say, well, then that renders the analysis useless. Well, I would beg to disagree, because I don't think it renders the analysis useless. It does mean that you need to take the peak analysis with a little bit of a pinch of salt, perhaps. You need to not take it too seriously. It's not set in stone, because we know those peaks are not synchronized. And what you will generally find is that the peak analysis is not as good as the trough analysis. And in fact, we can demonstrate that point right here. Let's zoom in a little bit again and look in a bit more detail at this analysis. So first of all, we have our 9-year peak over here. There we go. All right. I believe that's a good peak. We could debate it, but I believe it's a good peak. Notice its rounded look. In stock markets, peaks are usually rounded. Okay. You generally have more than one opportunity to realize that the peak has occurred, which is an important point to make when we're discussing peaks. So the peaks are generally rounded, whereas the troughs tend to be very sharp and isolated. Okay, that tends to be the nature of the stock market, whereas peaks are rounded. Okay, so we have a 9-year peak over here in 2015. I'm going to give that a tick mark because I think that's a good placement for a peak. We have an 18-month peak over here, and that's in, when was that, 2016. Again, I'm going to give that a tick mark because I think that that's a fairly good position for the 18-month cycle peak. Then we have, if we look at the next shorter cycle, we have a 40-week cycle peak over here. That looks like a good, fairly clean peak. Another check mark. That's looking good to me so far. Then we have the 40-week cycle peak over here, and that is in, where is that? End of March 2017. That's over there. Okay, that's not really very good. I hope you can see that. And in fact, what we'll do is we'll zoom in here and we'll take a look at this analysis, because when we're considering peaks, it's important that we really study the analysis a little bit and make sure that we've understood what it's saying. So there's the 18-month cycle peak over there, and here is the 40-week cycle peak. Okay, that's not really so good, is it? Here's a 20-week peak, and that's the 20-week peak over there. That looks good. I'm going to give that a check mark. But I'm going to give this a question mark. And where should that 40-week cycle peak be? It should almost certainly be over here. So let's see. Oh, dear, I've wiped that out. That wasn't really what I wanted to do. There's the 40-week cycle peak that I think would be a better 40-week cycle peak. So now what we can do is we can start measuring distances from this 18-month peak to this 40-week peak over here is only 28 weeks. Okay, so you can see why the software has put the 40-week peak over here. That's still a short 40-week cycle at 33.3 weeks. I am in fact using a short nominal model here. So the 40-week peak should average about 33 weeks, I think is about the average length of the 40-week cycle that I'm working with here. But the point is that the placement of that peak is not nearly as good as you would expect normally. Okay, and here we have a 20-week peak over there. So if we measure the distance from where we think that peak should be, then we have a pretty long 20-week cycle that played out over there at 161 days or 23 weeks. You can see when you start interrogating a peak analysis, quite a lot of anomalies sort of poke their heads up, and you can see some things that just aren't making sense in the analysis. Now, some people would say, oh, well, at this point I'm going to discard this analysis and I'm not even going to think about it because it just doesn't really work for me. I think that's a mistake, because there is some very useful information that we can gather from this analysis. We accept the fact that it's not a perfect analysis. The peaks aren't synchronized and they are quite difficult to analyze, but nevertheless we have some interesting information available to us here. In particular, the useful piece of information is this nest of highs. Okay, I've sort of rather drawn over it, but that nest of highs tells us that the market is now heading into an 18-month cycle peak. Okay, that's a really useful piece of information. If we are approaching an 18-month cycle peak, then we need to take that peak seriously. 18 months is quite a long time, depending obviously on your trading time frame, but 18 months is a pretty big peak for most people, and so we need to take that peak seriously. Let's just zoom back a little bit and let me show you another way in which one can think about what's happening with the peaks here. Even if you don't want to take the peak analysis too seriously, you would still want to identify prominent peaks that have occurred in the market and measure the time since those peaks occurred. Now, as I mentioned, I'm working with a short nominal model here, and the 18-month cycle is closer to 15 months than 18 months. So two 18-month cycles would be at about 30 months, and 30 months is on this day over here, which is pretty much next week, Okay, so that would be 30 months since the very big peak in 2015. So here again I'm going to suggest a little bit of a mind shift practice here. Let's say that we don't put labels on these peaks. We just look at the peaks and we say, oh, that's a pretty important peak, and we measure the distance from that peak. Now in Sentient Trader we can do that. Right click and we count the bars. And let's move that up a little bit. There we go. So you can see that as of today, or as of Friday, because I'm working with Friday's data, we had 903 bars from that very big peak in 2015. I'm not going to give it a name. I'm just going to say it was a big peak in 2015. We also had a pretty big peak, probably a peak of the 18-month cycle, but let's not give it a name just yet. But we had a pretty big peak over here in August of 2016. Now, do you notice something about those two numbers? 903 and 453. Okay, do you notice a rhythm there? What is 453 multiplied by 2? It is, of course, 906. And we are currently, or as of Friday, sitting at 903 bars. So we have an interesting rhythm developing. So even if we don't label those peaks and say that's an 18-month peak, that's a 9-year peak, we don't label them. We just say those are pretty big peaks, and they're quite important to us. We have a distinct rhythm forming there, and that is a clear indication, in my opinion, that we are due for another peak. Okay, so we had a big peak over here in 2015. We have another big peak here in August of 2016, and we have almost exactly the same number of bars have played out since that August 2016 peak. And so just in terms of very simple rhythm, we should be expecting some kind of another peak to form at the moment. Let's clear that, and let's put some counts on these peaks over here. There is a peak that occurred 254 bars ago, 36.3 weeks. Now the average length of a 40-week cycle, you probably know, is 274 days. So that would indicate that we're looking for a peak in about 20 days. Although, as I've mentioned, I believe that we should be working with a shorter nominal model up at the top. So that peak is probably due. We're expecting it to happen fairly soon. Here is another peak, and we can count the bars from that peak. That was probably a 20-week peak. There have been 94 bars since that 20-week peak. And according to this nominal model that I'm working with, I can tell you that the magic number there is 101 bars, 102 bars, I think. So that would seem to indicate that we're expecting a peak based purely on the rhythm of these peaks. We're expecting a peak to happen fairly soon. Or, yes, it might have happened. Did it happen last week? Well, possibly. Okay, so all of those bar counts are telling us to expect some kind of a peak to form fairly soon in the market. So let's just zoom in again. In fact, no, what I'm going to do is I'm going to zoom out, and let's slide this thing along over here so that we can see everything from about here to there, because we need to speak about that. Okay, so as you can see from this nest of highs, I am expecting a peak. That's why I've called this webinar the Peak Watch, because I think it's time for us to start watching for a peak to form in the market. Now, the other really useful thing about performing a dual analysis is the concept of zigzags, which I have spoken about in a previous webinar. The concept of zigzags is that price has a tendency to move from a peak of a particular cycle down to the trough of that same cycle, and then back to the peak of that cycle, and so forth. Okay, we can take a look at a few examples that have played out in the past. But here's the important thing: if this is an 18-month cycle peak, then what would we expect? We would expect price to move from this peak, once it has formed and been confirmed, we'd expect price to move from that 18-month peak down to the next 18-month trough. When is that 18-month trough expected? As you can see, it's expected pretty much early 2019. So we would expect price to move down into that 18-month cycle trough. Okay, how will price move down into that 18-month cycle trough? What it will do is it will first move down to the largest trough that it would encounter on the way to that 18-month cycle trough, which is of course this 40-week cycle trough, which is expected in about May of next year. So to complete the true zigzag, we would expect price to move down into the 40-week cycle trough in May of 2018. Then price would be expected to move up into the 40-week cycle peak, which is expected in July or August of next year, and that could be a nice, good, strong move up. And then price will continue downwards into the 18-month cycle trough that we're expecting towards the beginning of 2019. So that is the zigzag. And being able to anticipate the times of these turns is the great benefit of performing a dual analysis. Okay, so that's the sort of shape that we're looking at playing out until early 2019. Let me just take a little bit of a step back and speak now about this 18-month cycle trough. I mentioned a little earlier in today's webinar that the second 18-month cycle, and here we're looking at the troughs, the trough analysis, this second 18-month cycle in the current 54-month cycle is expected to be fairly neutral. In other words, it will have a first peak, then price will come down, then price will go back up again, and price will come down, and we'll end up with a neutral shaped cycle. Neutral, and in my opinion slightly bearish. Okay, so it's going to be more on the bearish side than completely neutral. So I think it's unlikely that we're going to see a higher peak here, but of course it's possible. But the general shape of this 18-month cycle is expected to be neutral, slightly bearish, and I hope that you notice that the shape that I've drawn here is in fact exactly the same shape that I drew just a moment ago, with price coming down into a 40-week cycle trough in May of next year, coming up to a 40-week cycle peak in July, August of next year, and then finally coming down into this 18-month cycle trough, which is expected in early 2019. So I hope you can see how these different pieces of the puzzle are really fitting together quite well. So that is our expectation, that the market is going to form a peak fairly soon, and that then we're going to see a move down into early 2019. So if you were to ask me now, what is my outlook for the year 2018, I would simply draw this zigzag on the chart again, and I would say my outlook for the year 2018 is that the stock markets are going to decline up until sort of May, early summer, and then they in the northern hemisphere, and then they're going to bounce up again, and then they're going to continue downwards. So the general outlook for the year 2018, in my opinion, is that the market is going to turn down. Now, generally I'm very careful about making sort of long-term announcements like that, because an important aspect of Hurst cycles is that with every piece of new incoming data, you re-perform your analysis, or you update your analysis. And so it's a really foolish thing to do, to start projecting forward by an entire year, because if the data that comes in, if what happens in the markets indicates to me that this analysis is wrong in any regard, in terms of the peak analysis or the trough analysis, then I will immediately update my analysis. And it's very important as a Hurst cycles analyst to not let your ego get in the way of your analysis. So you need to update your analysis, and you turn around again, and you might be saying exactly the opposite after a little bit of after a reanalysis. You might be saying, actually no, I was wrong, and this is the better analysis. But for as long as this analysis remains valid, the outlook for the year 2018 is, in my opinion, for the stock markets to be dropping mostly through the year. although of course we will have a reprieve between May and August. So now let's just speak about another few things here. I have mentioned several times, okay, I'm expecting a peak to form in the markets, and so some of you might be saying, oh yes, but the market peaked last week on Thursday, or was it Thursday or Tuesday? I think it was different in different markets, but there was a peak in the markets last week. Is that the peak? Well, it might be, but of course we have to use our cycle tools to determine where that peak is. And so our primary cycle tools are, of course, the FLD and the VTL. So let's take a look at some FLDs, and let's plot a few FLDs here, and let's ask ourselves at what point would we be convinced that this market has formed a peak. And I'm not going to go into too much detail because we are running into the end of this webinar, so I'm not going to split hairs with all of this. But here are three of our FLDs, and if we take a look at the detail, let's just focus for now on the 20-day FLD, which is certainly one of my favorite FLDs. And here is the 80-day cycle trough. I recorded a video about 2 weeks ago, I think it was, in which I mentioned that I believed the 80-day cycle trough had formed at this point. Of course, that might not be the 80-day cycle, but let's not get sidetracked into a debate about that. What we would expect if that was the 80-day cycle trough is for price to bounce up, as it has done. We would have an A category interaction, which was right there. It was that bounce at the FLD. Then we are probably witnessing a bit of a double B category interaction. The first one occurred at the 10-day cycle trough, and the next B category interaction we would expect to happen at the 20-day cycle trough. So a 20-day cycle most probably formed, in my opinion, last week. What do we expect at the 20-day cycle trough as a matter of interest? We expect the 20-day FLD to provide support for price. Okay, so as I think you can see, that is indeed exactly what the 20-day FLD did. The 20-day FLD provided support. It provided approximate support, not exactly to the tick, obviously. We can see that on Thursday, price dropped down fairly far below that 20-day FLD, and then the 20-day FLD provided another stopping point on Friday. So the 20-day FLD has definitely provided support so far. Does that mean price is going to bounce out of the 20-day FLD and roar upwards up to new highs? Well, it is possible as it approaches the peak, but because we're approaching the peak and because we're getting so close, and all these circles and whiskers over here are very ominous, because we're approaching that peak, we need to be very careful. We need to watch this market carefully. And if the current 80-day cycle is going to turn out to be a bearish one, which is very possible, then we're going to start seeing some cracks appearing. And certainly some of the initial cracks would be for the C category interaction, which is happening now, to not provide us with a new high, and then for price to come back down below this 20-day FLD. So we need to be on the lookout for a bearish cycle developing. There isn't anything overtly bearish yet. That 20-day FLD has provided support for price. We can't complain about that. It's not bearish yet, but we definitely need to be on the lookout. So the 20-day FLD, is it going to be useful in terms of identifying this this big peak that we're expecting? In my opinion, it's not really going to be very useful, and the reason for that is because the markets have been going up for so long. Let me just zoom back out again. We're in a position now where price is pretty much sort of mangled up in there with the FLD. And so because price is in there with the FLD, it's going to be difficult to really define a very clean break below that FLD. Okay, and of course, if price drops down below the FLD, that only confirms the formation of a 40-day cycle peak. So it's quite possible that the peak that formed last week was only a 40-day cycle peak, and that we've got another 40 days to go, or another 28 days, I think, is the length of this nominal model. So we've got about another month, 3 weeks to a month before the big peak forms. Okay, there is that big peak again. But again, it would be foolish for us to sit back and relax and say, don't worry, there's another 3 to 4 weeks to go before that peak forms. We have to start watching this market, which is why I call this webinar the Peak Watch. It's important to start watching. If some bearish signs start developing, then we need to be ready to act. But the simple answer here is that the 20-day FLD does not provide us with a tremendous amount of information. What about the 40-day FLD? Well, there's the 40-day FLD, and it was very interesting to note the price came down to the 40-day FLD last week, tapped it, and is bouncing back up again. Price is now above that 40-day FLD. If price breaks down below that 40-day FLD, then it would tell us that that a 40-day cycle peak has formed in the market. Well, yes, there is that 40-day cycle peak. We're expecting it. It looks as if though it happened. Not every interaction with an FLD provides you with tremendously useful information. Some of it is kind of, I already knew that information. So the fact that a 40-day cycle peak has formed in the market isn't really news. And it isn't really something we're going to sort of jump and react to immediately. Let's take a look at the 80-day FLD. Oops, that's the 20-week FLD, which is quite far away, so we're not thinking about that just yet. Here is the 80-day FLD. So now if price drops down below this 80-day FLD, then here indeed we would have evidence that a peak of at least 80-day magnitude has formed in the market. So of all the FLDs, the FLD that I would certainly be interested in watching is the 80-day FLD, and I'm going to watch that 80-day FLD with great interest, because if price drops down below that 80-day FLD, I'm going to take that as a fairly good sign that the 80-day cycle peak has formed in the markets, and if that 80-day cycle peak has formed in the markets, then the chances are that that is also the 20-week, 40-week, and 18-month cycle peak that we are expecting. Okay, so that's a useful FLD for you to watch. But now there is another tool that I speak much less about, and that is, of course, the valid trend line. And we have a few valid trend lines here which are really very useful. Now, when a valid trend line is crossed, it tells us that a peak of 1 cycle longer, 1 degree longer, has formed in the market. So let's have a look at 3 VTLs just very quickly, and let me hide these other ones so we can focus on them one at a time. We're expecting a peak of the 18-month cycle to form over here. When price crosses the 40-week VTL, that is going to provide us with evidence that the 18-month cycle has formed in the market. There is that 40-week VTL. I am certainly going to be watching that VTL very carefully over the next while to find evidence that the 18-month cycle peak has formed. But there are some other VTLs as well. Let's take a look at the 20-week VTL. Now, when the 20-week VTL is crossed, that provides us with evidence that the 40-week cycle peak has formed in the market. If that 40-week cycle peak has formed in the market, and of course it's a peak that we're expecting, then that would also be, by the principle of synchronicity, which of course doesn't apply to peaks, but it would also be the peak according to our dual analysis concept of the 18-month cycle. And so we could also watch this 20-week VTL. However, the 20-week VTL is below the 40-week VTL, and so in this instance, it's not really providing us with any very interesting information. So I'm going to rub out that arrow, and let's hide that 20-week VTL because it's not very useful. However, there is another VTL which is of great interest to us, and that is this 80-day VTL over here. Now, there are a few interesting things to be said about this 80-day VTL, and let me just zoom in and explain how this 80-day VTL has been built. according to Hurst's rules, the 80-day VTL must connect two consecutive troughs of the 80-day cycle. So the previous 80-day cycle trough was over here on the 21st of August. It was also an 18-month cycle trough, but there it is. There's the 80-day cycle trough. And the next 80-day cycle trough was, in my opinion, on this date over here, which was the 25th of October. There's the next 80-day cycle trough. Okay, so the 80-day VTL should be drawn to join those two troughs. Now you will notice, depending how good your eyes are, you will notice that in fact that line is not joining those two troughs. Why is that? Well, the second rule that Hurst defined was that the VTL should be drawn in such a way that no price is crossed by that VTL. And you can see this low over here on the, was that the 29th of August? That low would drop ever so slightly below that VTL were we to draw it there. So what the software does is it obeys Hurst's second rule, and it drops that VTL down there so that we are drawing a VTL that is not crossed by any of the prices in between the two 80-day cycle troughs. And I say in between the two 80-day cycle troughs because I spent a lot of time studying this particular part of the Hurst Cycles course, and he doesn't actually specify that price mustn't cross prices, that the VTL mustn't cross prices between the two troughs, but I think it's implicit in what he says. And here the software has done something interesting, something slightly over and beyond, if you like, Hurst's original rules, which is that it has displaced that VTL so that it is drawn below the bottom of this bar over here. And I fairly often receive emails about this. I receive emails asking, why is that VTL drawn below that line? The reason why is because the software is doing something that I've always done with my Hurst cycles analysis. We have two troughs here, and let me just clear those pens and be absolutely clear about this. We have this trough and we have this trough. Strictly speaking, the VTL should be drawn below this trough. Okay? But this trough over here is also a possible position for the 80-day cycle trough. If you're going to make trading decisions on the basis of a VTL, you want to make sure that VTL is drawn across the correct trough. So what Sentient Trader has done is, because it has phased this 80-day cycle trough over there, it's not being a stupid piece of software that just says, well, there's the 80-day cycle, you know, we have to draw the VTL there. It's allowing a little bit of flexibility, and it's saying this trough over here, which was last Thursday, might be the correct placement for that 80-day cycle trough. So therefore, in terms of plotting the VTL, I'm actually going to plot that VTL below that line. And the reason it does that is because the VTL is used to make trading decisions. So yes, we can question the analysis and we can get very involved in analytical discussions, but when you're watching a line, as we are now, in order to make trading decisions, you want to make sure that that line takes all the possibilities into account, and you want to make sure that that line is really a fairly good, accurate line. And with it drawn across this trough over here as opposed to this trough over there, it has positioned that line just a little bit further away from price. You see it's sort of pulled it down a little bit, and it's given us just that little bit of extra wiggle room, if you like, before price crosses down below that VTL. So I am going to watch this 80-day VTL, and if price crosses down below that 80-day VTL, I'm going to say the chances are fairly good that the 20-week cycle has formed a peak in this market. If the 20-week cycle has formed a peak, then it is likely that the 40-week and the 18-month cycles have also formed peaks and that we have started our move downwards. But because this VTL is so close to price at the moment, and I can zoom in and we can see just how close, because that 80-day VTL is so close to price, I'm not going to jump straight into a short trade on the basis of that line, but it's a very useful line to watch. I do believe. Okay, we are running over time, but I would like to quickly show you one more thing, which is the composite model line. Now, the composite model line I've spoken about many times in these webinars, and the composite model line takes the results of the analysis and it plots it on your chart to show you what the market would have looked like if the only thing that was moving the markets was the analysis that you have on your chart. So let's put up our composite model line here on this chart. There is our composite model line. As you can see, it tracks price in the past fairly closely. That's not magic. It's because that is that is the result of the analysis that we have performed. Now, according to this composite model line, you can see that we have price peaking fairly soon. There's the peak coming up fairly soon, and according to this composite model line, we have a fairly complex peak. I mentioned earlier the concept of rounded peaks, so we have a fairly sort of complex peak forming, and then price is going to move down into this 18-month cycle trough over here in 2019. Okay, the really big trough that we're moving down into is this 9-year cycle trough in 2020. Okay, so the composite model line is showing us a bit of a downward slant, but you must not use the composite model line as gospel. This is not something that is absolutely set in stone. The composite model line simply gives you another way of visualizing what your analysis is telling you. And there's a very important subtlety that I must point out. That is that Sentient Trader is including something called sigma L, which is the sum of all the longer cycles that have been found in this analysis. And if I exclude sigma L, which is something that you must always play with and explore, then look at that composite model line. Look how different that is. Okay? It is very different. Why is that? Well, because our analysis, if we exclude sigma L, tells us that we had a 9-year cycle peak here in 2015, and so the composite model line is using only the cycle information, and so it is telling us that should have been the peak in price, and then of course price should move down into the 9-year cycle peak in 2020. So why is the composite model line showing us something so different when we exclude sigma L? Because sigma L is the sum of all the longer cycles, and as I've already mentioned, a good deal of the current bullishness at the moment in the markets, I believe, comes from the 18-year cycle, and the 18-year cycle is of course included in sigma L. By definition, sigma L is the sum of all the longer cycles than the cycles that are shown in this analysis, and the 18-year cycle is indeed a longer cycle, because the longest cycle that we have in this analysis is the 9-year cycle, and so the 18-year cycle is indeed a longer cycle. So what should we do? How should we handle this? Well, I'm going to show you a little trick in terms of what you need to do. First of all, let's understand what a Sentient Trader is calculating sigma L to be. So here we go. I'm plotting using the cycle lines feature. I'm plotting the calculation that the software has done for sigma L. Okay. Now, interesting, we see some higher frequency vibrations in sigma L. Isn't that very interesting? But we don't have time to speak about that now. I have spoken about it in a previous webinar. But this blue line represents sigma L. Now, sigma L in theory moves very slowly. So we can see that sigma L basically came down with some higher frequency sort of fluctuations, formed a low point over here. 18-year cycle trough, anybody? Maybe over there. Okay, and it moved up again, and it is expected to form a peak, and then it's going to move down again. Now that it is expected to form a peak is purely speculation. Sentient Trader uses a fairly advanced algorithm to work out the sigma L line. I won't go into it now. It'll take several hours to explain, but basically it tracks this movement, and it uses various algorithms for projecting what is happening forward, and what it is expecting to happen is for sigma L to reverse. In other words, the 18-year cycle, which is probably providing us with most of our sigma L calculation here, is expected to turn around and move downwards fairly soon. That's according to that that algorithm. Whether that's actually going to happen, we don't, of course, know. So how do we work with this? We have a composite model line that just looks like a bit of a mess. So how do we work with it? Well, what we do is we zoom in and focus on the period of time that we are interested in. And we look at what the composite model line is telling us to expect over that period of time. Now, just a reminder, I have excluded sigma L. I think you can see that. It just fits into the video. I have excluded sigma L. So this is using purely the cycle information, no sigma L, no calculated longer cycles or anything like that. And what is this composite model line telling us? It's telling us that price is coming up into an 18-month cycle peak, which is expected here, which is of course what we've already discussed and we already know is going to happen. Then it expects price to move down into a 40-week cycle trough in May of next year. Then price is going to bounce up into a 40-week cycle peak in July, August of next year, and then price is going to come down into the 18-month cycle trough in early 2019. So there's that same drawing. I've drawn it now several different times, at least 3 different times today. All of the analysis that I have on this chart, everything points to the fact that that is what we are expecting to happen in the markets. All right, so we had a question about the 40-week cycle there. So let me just go back in Sentient Trader. And of course, Sentient Trader will, am I working on the right application? I think so. Sentient Trader will plot the VTL even if you can't see both of the troughs on your, on the current zoom of your chart. So there is that previous 40-week trough, which was in fact the day of the US elections. In fact, strictly speaking, I believe that the 40-week trough should have been just a few days or a week before those US elections, because the US elections just simply caused a lot of volatility. Okay, so you had a lower price on the day of the election, but in fact the 40-week trough probably, strictly speaking, should really have been placed the week before, which will give us a slightly different VTL, of course, if we were to move the line there. And we also had a question about the composite model line and how much data do you need to analyze in order to make sure you've got a really clean analysis and that you don't have this sigma L problem. Well, unfortunately, the truth is that's a bit like sort of looking for the Holy Grail, and I think it's a rule of diminishing returns. You can have more and more data and analyze more and more data, and you get more and more information. But the truth is there is always another cycle, okay? Because there are an infinite number of cycles. So if you include the 18-year cycle, then we're going to be looking at a 36-year cycle, or perhaps even a 54-year cycle, and so forth. Then there's a 108-year cycle, and it keeps on going forever. So at some point, the amount of extra effort that you make to perform a longer term analysis doesn't really pay off. And so you just have to accept that there are some unknowns, and sigma L is really one of those unknowns. So what you need to do, as I've just demonstrated, is you zoom in on your chart onto the period of time that you are interested in. You have a look at your composite model line, see what information it provides you for that period of time, including sigma L, and then you turn sigma L off and you have a look at the difference. And the difference is, of course, the unknown, or what the software is trying to project in terms of the longer cycles, the 18-year cycle and so forth. The message here is still fairly clear. Even though we have the unknown sigma L factor, the message is still fairly clear. Both of these composite model lines are telling us that we are approaching a fairly important peak. Okay, and then the market's going to come down into May of next year. Then it's going to come up into August of next year, and then it's going to drop again. So the takeaway message, I believe, is that is what's going to happen. regardless of what's really happening with that 18-year cycle, because the truth is we don't know on the basis of this analysis. As I mentioned, I might even do it in our next webinar. I'm going to take a look at a much longer term analysis, which I hope you'll find interesting, and we'll start speaking about some of those longer cycles. So on that note, I would like to say thank you very much for joining me in today's webinar. Thank you for your interest in Hurst cycles. I'm very pleased to hear that you found it interesting, Cindy. We've had a lot of comments, which has been great. Thank you for the conversation. Our next webinar is going to be in December, the second Monday of December. I'm going to be traveling. I'm going to be in South Africa at that time, but that's why I took a slightly different technical approach today. So I'm going to be recording the video slightly earlier in the day, because internet connections in South Africa are not as good as might be expected. And so again, it will be a live webinar, but I will be probably playing back a recorded video so that hopefully we maintain a high quality to the webinar. Thank you very much for your time. I look forward to seeing you on our next webinar, and in the meantime, I wish you profitable trading.